Again, my name is Jaron Rice. I'm the founder and CEO of Magothy Payments, Maryland's highest rated merchant services provider. And I wanted to go over the topic of chargebacks. My company specifically, we focus on large ticket card not present transactions for home improvement contractors, home services companies. And so chargebacks are things that we deal with quite a bit. And over the years, we've mastered our craft, so to speak. And so there's a lot of good information for business owners on how to prevent them and how to fight them when they happen. So we'll start with what we'll go over. What is a chargeback? What happens? Who's involved? The whole liability timeline, how to prevent them, and how to fight them. One of my favorite sayings of all time, and I don't know who first said it, but an ounce of prevention is worth a pound of cure. So what is a chargeback? A chargeback happens when a consumer contacts their bank, the issuing bank, the bank that issued the credit card or debit card, and they dispute a transaction. So for this presentation, we're going to assume that the consumer has entered into some kind of agreement with the merchant to conduct commerce, and that it's not a fraudulent transaction that somebody found a card on the ground and decided to start running transactions. So, as you know, there are a number of card brands. Visa, MasterCard, Amex, and Discover are the four major ones. Visa is the lion. They hold the lion's share in the market. I think last count, it's like 62, 64%, something like that, of credit card transactions are Visa branded cards. And so Visa essentially sets the rules. When they make a rule or regulation, the other card brands sort of follow what Visa's doing. There are usually some differences, but they're often very similar. And so when a consumer disputes a transaction, Visa will issue a code for that specific transaction and that specific chargeback. And it actually doesn't show it on the slide here, but the numbers, these are actually 13.1, 13.2, 13.3. And so if you look on the right-hand side, the types of disputes, there's most common merchandise or services not received, canceling a recurring transaction, it's not described, or it's defective, it's counterfeit, it was misrepresented, credit not processed, which means that there was a refund that was owed that was never paid out. They canceled the service or the merchandise. The original credit transaction was not accepted, meaning a refund was attempted, but the cardholder rejected it or their bank rejected it. And then lastly, the non-receipt of cash, which is an ATM or cashback transactions. So Visa recently updated their dispute codes to decrease the amount of friendly fraud. And friendly fraud occurs when a transaction legitimately happened, but the cardholder doesn't recognize the line item on their statement or in their banking app. And a good example for this is, we all know that companies have legal business names, but they can also do business as a different name. So if you have, Joe's Market with a legal business name of 123 XYZ Enterprises LLC, and that's what shows up on a customer's bank statement, if someone's reviewing their bank statement from 2 months ago and they see a $47 charge at 123 XYZ Enterprises, and they don't recognize that, oftentimes they will call their bank and dispute the transaction because they don't recognize the name, even though they legitimately went to that business. And so that was happening a lot. And so Visa sort of updated the chargeback codes to minimize those types of chargebacks. So the whole process, the flow from start to finish. When the dispute is issued, the acquiring bank or the processor that authorized the transaction will debit the funds in the amount of that chargeback from the merchant and hold those funds in escrow while the investigation is going on. This is very, very, very inconvenient for the merchant because it often happens with zero warning. And the reason this is the case, because the card brands and the issuing banks give their cardholders, their clients, a zero fraud guarantee. If the chargeback is found to be legitimate and the merchant is insolvent, the merchant doesn't have the funds to pay back the cardholder, then the acquiring bank that authorized the transaction is responsible to pay the cardholder back. And so in that relationship, even though the merchant is the client of the acquiring bank is trying to protect themselves from a loss on behalf of their client. And so if there is a chargeback, they want to get their hands on those funds as soon as possible to make sure that they have it in the event that they have to pay it back. So after the dispute is issued, the acquiring bank debits those funds. They give the merchant 30 days to respond. So an official document called a chargeback advice is issued. It's the official form that shows the date of the transaction, the dollar amount, the last four of the card number, and what the cardholder is claiming. So it lists the dispute code. If the, what the heck? If the transaction is disputed, hang on a second.
1 second. All right. We'll go ahead and remove.
Maybe shouldn't open this to the public.
That's all right. Go ahead and remove that attendee and keep it moving. Sorry about that, Jaron.
No worries. So if they don't respond, they lose by default, right? So the card brands give 30 days. Typically, the acquiring bank wants to have the response back from the merchant within 21 to 25 days so that they have a cushion and they can submit everything. The decision comes when the issuing bank, the acquiring bank, and the card brand all kind of put their heads together and review the information and say what is most likely to have happened in this situation. So you have a couple of outcomes. The chargeback is upheld, meaning the cardholder wins. The chargeback is reversed, meaning the merchant wins. And then if either of those scenarios occurs, then the losing party has the option to send it to pre-arbitration, which means we don't agree with this, we're going to fight it. And then that's the next step in the process, which means the merchant is going to have to pay $500 to go to arbitration and have a third-party arbiter review all of the information and sort of make a decision based on that information. Okay. In those situations, obviously, if it costs $500 to essentially get your money back, the merchant has to sort of make a business decision as to whether or not it's even worth it at that point, right? Because you have a $75 chargeback, it's probably not worth $500 to take that to arbitration. Now, there is the principle, and I have had clients pay $500 willingly to win a $79 chargeback because on the principle, they did not want this customer to cheat them. So it really depends. But when you're talking about high dollar transactions for home improvement contractors that are, I mean, we've handled chargebacks that are $19,000, $25,000, $30,000. In that case, it's definitely worth it to go to arbitration. Next slide here. So the parties that are involved, you have the acquiring bank and the processor. Their client is the merchant. You have the issuing bank. Their client is the cardholder. And then you have the card brand, Visa, MasterCard, Amex, Discover. And both the acquiring bank and the issuing bank are their clients. So it sort of creates this balance of power, if you will. However, American Express and Discover function both as the issuing bank and the card brand, right? So like with Visa, you have the issuing banks like Capital One and Bank of America and Wells Fargo. Those are the banks that issue the cards, and Visa is the card brand. Typically, when it's an American Express or Discover, they are the issuing bank and the card brand. And so in those situations, they occupy two of the seats at the table, and it can make winning those chargebacks more difficult. When you're looking at the liability timeline for Visa and MasterCard, a merchant is liable for a chargeback for 120 days from either the transaction date or the delivery of goods and services, whichever is later. Now, this can be problematic when you have a deposit for a future project or a future event, right? So you book a hotel room for 6 months from now, your stay hasn't occurred. So that date of delivery of goods and services doesn't occur until 120 days after you've actually stayed there. And so when you're dealing with home improvement, contractors, when someone is collecting a deposit, this can sort of muddy the waters as it relates to how long the merchant is on the hook. And we saw this a lot with COVID when the supply chains were all sorts of jacked up. And what a window project where you're ordering custom windows that would normally take 6 weeks were now taking 6 to 8 months. That timeline was being pushed back, and impatient cardholders were kind of falling into this situation where it's like they made a deposit, they're paying on this debt that they've acquired that for a project that hasn't started yet, right? And so for Visa and MasterCard, it's a 120-day window. For American Express, it's 1 full year from the transaction date or the date of delivery of goods and services. And so, again, that's a very, very long time to be on the hook for that. So with all of that, the next question becomes, how do you prevent this from happening, right? How do you prevent a customer from disputing a transaction after the fact when it could disrupt your cash flow or your business as a whole. I mean, think about a chargeback of several $1,000s posting to your account 2 days before you run payroll and you had no idea that it was coming. So the first thing, communication is key, right? We have found sort of an alarming trend when it comes to a lack of communication with transactions. So you want to make sure that you document everything. Document everything and make sure the customers are signing it, initialing it. Don't do additional work or change the scope of the project without signed documentation. Unfortunately, we see this a lot, especially with smaller, newer contractors, but they will have a project that says they're going to do this. And as they get into the project, the homeowner decides there's something else that they want done, or they uncover some sort of additional issue that needs to be addressed. And they verbally agree on pricing or scope of project or whatever, but there's no signed and written addendum changing the scope of work. And whenever that happens and you don't have documentation of that, the likelihood of a chargeback is very, very high. Don't charge the final balance on a project you accept a deposit on without notifying the customer by phone or email beforehand, right? That's really, really, really important, because sometimes a contractor will finish the work and he'll have it in the agreement that once we're done the work, we're going to charge the final balance. But if that is not properly communicated to the customer, it can cause problems, right? Because the customer may have wanted to put the final balance on a different card than what they used for the deposit. And if the contractor is pulling those funds without giving them a heads up, it can definitely cause issues. Lastly, you want to make sure that your agreement explicitly states that your customer agrees to card authorization for the deposit and the final balance that's due upon completion. Okay. And this is a really a point that I want to hit home. Contractor agreements will often give the terms of payment from the standpoint of what the customer owes and when it's owed, but that's not the same thing as the customer giving the contractor authorization to pull those funds from the credit card that was provided during the deposit. And so you can legally have rights to funds where if you took them to small claims court or took them to court in general to sue them for their balance, you would win that judgment. But that is not the same thing as having authorization to run that card according to the card brands. And so you want to make sure that the agreement that the customer is signing explicitly states that. Another way to prevent chargebacks is customer service, right? The chargeback mechanism was not designed to be a customer service tool. Unfortunately, that's how it's used. But many of the chargebacks that occur could be avoided with compromise, right? If you're doing a good job, you've got good workmanship, you've got good communication, and you're being reasonable, you would see a dramatic decreased likelihood of chargebacks occurring. It's not 100%. It's not foolproof. Everybody knows there are some people that just, no matter what you do, they're never going to be happy. And unfortunately, you're going to have to deal with those people. But for the vast majority of them, if you do good work, if you communicate, and you have reasonable expectations, you can avoid the chargebacks.
Just before you move on, we have a few great questions actually that transition from what you were just talking about. If you don't mind, real quick, let me just step in from Rolanda. They're a travel agency owner. What does one do when a client signs a credit card authorization form for each transaction, then files a chargeback citing as a reason, quote unquote, fraud, no cardholder authorization?
So it depends on how the card was accepted, right? So if you, let's say, since the EMV compliant mandate of 2015, let's say you have one of those, not to pick on this company, but one of those square readers that plugs into your phone and it only swipes the mag stripe and it doesn't read the EMV chip. If you swipe an EMV card, you cannot contest a chargeback under any circumstance. So consumers are starting to learn and understand that the EMV compliance mandate, which shifted the liability from the bank to the merchant if an authorized or cloned magstripe card is used instead of the EMV chip. In those scenarios, there's nothing you can do. You need to upgrade your equipment. If you're in a card present environment and you're accepting physical cards, they need to be able to read the chip either through tap or dipping the card. If you're in a card not present environment, there are a couple of ways that you can sort of figure out whether actual authorization was used. There are services like 3D Secure and Verified by Visa that you can add in an e-commerce environment that will require the cardholder to put in additional information to verify that they are who they say they are. A lot of gateways and shopping carts will also capture IP addresses where transactions originate. But you should have, if you're functioning in a card not present environment and you have somewhat of a transient client base, meaning people that are not regular customers, you want to make sure that the method that you are accepting payments has address verification service, AVS, inputs when you input that card information. And what that means is if you're keying in a transaction, you should be keying in the numerical portion of the street address and the zip code. And when you run a transaction, it should show when that transaction happens, whether or not the AVS passed. This was put in place to kind of fight card not present fraud so that someone couldn't find a card on the ground outside and then just start buying stuff online. And so you should have the settings as such that you get notified if they don't match. And in an e-commerce environment, you would want to have the transaction declined if the AVS information came back that it doesn't match. And so if you ran a transaction and it said that it matched the AVS matched on both the address and the zip code, then they typically can't say that there's no cardholder authorization because whoever input that card information knew the house number and knew the zip code. And if it was in fact fraud, the liability is not on the merchant. That liability is on the bank. So that shouldn't affect you. And if you can, now it doesn't mean that the cardholder is not going to try, and it doesn't mean that the issuing bank is not going to try because they don't want to pay it. They'd rather you pay it. But if you fight it and contest it properly, then the card brand and the acquiring bank will have your back with that documentation.
Great.
Hope that does that answer the question?
I do believe it does. Rolanda, if you need additional help, for sure, just drop in the chat. We got another question from Don, though. If they do have agreements signed, all T's crossed and I is dotted, and they still get her money back, it seems that business will lose every time dealing with this. You might have just addressed this a little bit.
Yeah, and so it can, like I said, it can be very difficult. We're dealing with a very difficult case like that right now. I won't go into too much detail, but it's we have a limousine company that charges for overages, right? You book 4 hours. If you take 6 hours, we will charge you for the extra time. It's documented, it's in their terms of services, customer signs on it. Customers over their time, merchant then bills the card as per the agreement for the overage, customer disputes it. In those scenarios, even with all that documentation showing this is what our terms say, this is how long it took, the customer disputes, it says, no, we weren't 6 hours, we weren't over, we were done. In those types of situations, it becomes a he said, she said. How much proof does the merchant have that they were 2 hours? They can say that they were, they can invoice them saying that they were, but in those situations, especially if you're dealing with like a Amex and Discover, it can lean, the burden of proof, unfortunately, is on the merchant to show. So the more documentation that you can have in those types of situations, the other option is suing them or engaging an attorney to let them know you're going to sue them. Because in situations like that, a lot of times, unfortunately, card holders feel like they're operating with impunity and that they have nothing to lose by trying to get their money back in these types of situations. That's just, it makes it difficult in those types of situations. But one of the things that I would offer, we have a service, and this is not something that's proprietary to us. This is a service available to most merchants. There's a fraud and chargeback prevention tool called Count, Count. It's owned by, I think it's owned by TransUnion. It's one of the credit reporting repositories. And what it does is at the time of authorization, it will give you a score and mark a transaction green, yellow, red based on the likelihood of a chargeback happening. And what it does is it looks at additional data associated with that cardholder, right? So if that cardholder disputes transactions with any sort of regularity, it's going to show a red flag on your system that says, hey, they authorized this transaction. All this information is correct. The billing address matches, the zip code matches, but this customer has a history of chargebacks. This will likely end in a chargeback for you. And it can give you that score in the dashboard post authorization so that you can decide whether you want to settle that transaction or whether you want to cancel it and void the transaction and not deal with that customer. And so there are technologies available that are helping merchants to avoid the Karens, if you will, that are going to make their lives difficult, because people like that, it's rare that this type of behavior is a runoff. If people are like that, they're like that, right? And so you're probably not the only business that has had to deal with things like that. And now all that data is being collected and bundled together in a tool that can help merchants avoid those people.
Gotcha. Yeah, is there a really quick, is there a cost for Count?
Yeah. So it depends on the provider that sets it up. I think in our day, I want to say it's like $15 a month, and then like 20 cents per transaction that flows through. But when you think about like how much it can protect you from, like when we've explained it to customers, they look at it and they're like, it's worth its weight in gold, right? It's inexpensive for the amount of preventative measures it will give you to avoid loss in those types of situations.
Yeah, great. And Rolanda, I do see your question. It's a specific sort of scenario. Maybe we save that for the end and let Jaron. You want to keep moving with your next slide, maybe?
Yep. All right. Actually, that was most of the information. So, more information about myself. We are a Torch Award winner, by the way.
Hey.
And my team, we are small but mighty. It's myself, my wife, Leah, and Jake. And I like to say that we are nimble, and having us, we're backed by a multi-billion-dollar bank, obviously, but having a small team has made us agile in times like COVID, when businesses have to change and pivot and kind of reevaluate what they're doing. We're able to kind of stay on top of things. And then contact information here. So we are all officially done.